let's continue our discussion regarding revenue and receipt cycle. Now we proceed to the different forms or documents initiated and processed by each department. So we already had different departments earlier. We already discussed the different departments, the different transactions within the department, and then at the same time, the possible controls within each department. So just a recap, we have your sales department. We also have your credit department. We also have your warehouse, your shipping, and then we have your accounting department. Okay, so let's start first with your sales order. This is the first form, also known as your order slip or your customer order. It describes the goods or services that are being ordered by the customer. So you already know that it starts with your sales department. And your sales department, from your sales department, the completed SO will be given to your customers, to your billing department, and to your shipping. So ultimately, it will end to your billing and your shipping and to your customers. And then we have also your delivery receipt, also known as your bill of lading or shipping document. This describes the goods to be shipped and serves as a contract between the courier and the seller. So this starts from the shipping department and it will be given by the customer, courier, and the billing department. So these persons are the end receiver of the different documents. So normally, if you see, we have here the source document, let's say, the source document is prepared in triplicate form and those triplicate items are given to customers, billing, and shipping. Ganun siya. Next, we have your sales invoice, also known as billing statement. It details the good or service sold, the amount due, and the terms of payment. So it is from the billing department and be given to customers, courier, and lastly, it will also be kept by the billing department. A copy will be kept by the billing department. Next, we have your payment advice, also known as your remittance advice. This document informs the seller that the goods or service sold has been paid. So this is normally initiated by the customer and it will be given to your AR department. Then the daily summary. This will come from your different departments, any daily transactions from the departments. But we said mostly the transactions or the daily transactions comes from your mailroom and your treasury department. And then it will be given to your different accounting department. So your AR department, general accounting, and then lastly your treasury. So on your treasury, normally what is given to your treasury is the summary of receipts. So you forward that also to your treasury department. Okay, so those are the different forms and documents, and who will have custody over those documents at the end of the whole process. At the same time, who initiates it. Next, we go to your test of controls. So we're done with the different departments. We're done with the different activities. We're done with the different forms. And we already know the different controls. Now, let's test the controls. If you still remember, we test depending on your particular assertion. So the first assertion that we will test is your existence or occurrence. So first, the recorded sales are for shipments actually made to customers. Now, normally you associate sales to your asset. Okay? You associate sales to your asset. And whenever we want to test your asset, our main assertion is existence, whether the asset exists. But if ever we want to test is a liability, then what we test is completeness. So why existence? Because normally asset is understated. Asset is normally overstated. And since it is overstated, then we check whether that particular asset exists. So the main assertion for asset is existence. While for liability, it is normally understated. And since it is understated, we want to see whether it is complete or not. So the main assertion we test for liability is completeness. So let's start first with the assertion existence or occurrence. So first, control. Recording of sales is supported by a customer's purchase order, and sales orders are approved by the credit departments and the approved executed shipping departments. If you still remember earlier, we have this process, right? So the sales order will be forwarded to your credit department, and once the credit department approve that, it will notify the sales department, and the credit department will forward the sales order to your warehouse for the possible release. So ultimately, we will now have a shipping document. Okay, so that's the whole process earlier that we have discussed. So that is the control in place. So the whole process is also the whole control in place. So how do we test that particular control? So we examine the customer PO, the sales order, the shipping documents, and the sales invoice. Why? We want to look into the segregation of duties. As you can see here, it is properly segregated. But the customer PO and the sales order comes from the sales department. The shipping document comes from the warehouse. And ultimately, the sales invoice will come from the billing department. So we want that those items, as properly laid out by our internal controls, were really segregated. So we test the authorization on each item so that we see if ever it is properly segregated. And each particular document, we see if ever it is approved by the proper department. So let's say for the sales order, whether it is approved by the credit department. For the shipping document, whether it is approved by, of course, your shipping department or your warehouse. And your sales invoice, whether it is initiated and approved by your billing department. So we look whether it contains the necessary approval, and we want that the terms and conditions should be consistent, because as a rule, what has been ordered should be filled. But in case it is not filled out, it means that possibly the inventory is not enough. So we look into the consistency of the documents starting from the purchase order or the sales order up to the invoice. What we want to test here is the proper segregation of duties, especially in the controls in your sales. Next, we want to see independent personnel who prepares the monthly statement and records the accounts receivable. If you still remember earlier, when we discussed the receipt cycle, we want to see from the mailroom. We want to see from the mailroom, we have your remittance advice and the check. This remittance advice and the check will be provided to your treasury. But at the same time, the mailroom will prepare a report, and this will given to your accounting department. So the treasury will deposit that to the bank. At the same time, it will again prepare a report, and you will give it to your accounting department. So those are the activities, and we want the controls that should be in place on those activities. So again, segregation of duty. So prepares the monthly statement as to the total receipt and the monthly statement as to what is deposited. At the same time, we want another person who records or update for the AR, especially the SL and the GL. So how do we test that control? So that we can see whether it is properly segregated, then we observe whether these duties are properly segregated. At the same time, you examine files on complaints received. Why? We look into the possible complaints as to your possible reports on your from your mailroom and your treasury, if in case those amounts does not tally. So therefore, if you want to look into the documents as to the revenue, or to check whether there is a proper segregation of duty on your revenue, what we test are the source documents. But if we want to test as to the receipt, what we test here is the different duties, or we observe the performance of the task. Why? If you look into our earlier discussion, mostly our source documents are processed in the sales cycle. While there's no document at all in your receipt. Purely what is prepared there is your payment advice and your summary. But almost all of the documents comes from your sales. Therefore, under your sales or revenue, we examine the documents, while under your receipt, we examine the whole process itself. So we try to observe whether the duties are properly segregated. And to test the segregation of duties for the sales, we just test the documents. And based on those documents, we look who approves them. If the approval or the person who approves those documents are different from each phase, then there's proper segregation of duties. And as to the second control, we observe the proper segregation of duties. Okay, so see the difference on those two controls. On the first control, what we wanted is to check the segregation of duties by looking into the source documents on who approves them. Once there's a different approval on each phase, then there's proper segregation of duties. While for the second control, we don't look into your source documents. Why? We don't have much source document. Our only source document there is normally your report or the payment advice. Since there's not much of source document, then what we test is we look into how they function, we look into their activities, and based on those activities, we look whether they are properly segregated. And how do we segregate it? Again, mailroom receives payment advice, prepares report, prepares that report to the accounting department. And the mailroom will provide now the remittance advice and the check to the treasury, and the treasury will now bank that or deposit that. At the same time, will prepare report to be given to the accounting department. So we look into whether there's proper segregation. Next, another assertion for sales, you have your completeness, that all sales transactions occurred are recorded. So what are the controls? So the first control is pre-numbered shipping documents are accounted to determine that all sales invoice is prepared for all shipments. All sales invoice is prepared for all shipments. If you still remember, as part of your shipping, one of the controls is a pre-numbered sales invoice, So that is the control in place. So to test that control, you just need to observe the procedure that they are really using a pre-numbered sales invoice. And they only use the sales invoice next to they pre-number it and they issue it based on those number. So if ever what is issued is 571, they will issue next would be 572. So that is what you need to observe. That once they issue the sales invoice, it follows also the pre-numbering. At the same time, you examine the invoice that bills the sale. So always remember, you try to connect this one with the other source documents. You connect this one to your other source document. So you look whether a sales invoice was properly shipped. Okay? Was properly shipped and this proper shipment was billed. Okay? So paikot-ikot lang siya. Kung na-ship siya, dapat na-bill siya. Kung na-bill siya, dapat may sales invoice. So you try to trace the sales invoice to the shipment and to the billing. Next control, pre-numbered sales invoices are accounted to determine that all sales are recorded. So we look now as to the number of sales invoices, and based on the number of sales invoices issued, that corresponds to the total sales that are recorded. So therefore, how do we test that control? You observe the recording process if the personal accounts for the numerical sequence. So as I told you earlier, if 571 was issued earlier, so the next should be 572. And next, we do tracing. So whenever we see tracing, it is from source documents to records. From source documents to records. So the source document is the sales invoice. We look whether it is recorded. Where is it recorded? To our sales journal. Next, procedures are in place to ensure timely recording of sales and proper cutoff are established. So what we want here is what we want here is if ever that is for January, the sales are properly recorded in January. So it is complete as of January. If it pertains to February, the amount of sale is complete as of February. That is what we want to achieve here. So how do we test that control? First, you inquire procedures that are followed. At the same time, you observe if procedures are followed, and then you inspect the report in the last shipment. By the way, katulad ng sinabi natin before, whenever we do test of controls, it is purely IOI plus rep performance. So, iikot lang yan sa inquiry, observation, and then inspection. Also, rep performance. So, yun lang normally. So, if ever you are given choices, iikot at iikot lang dapat yung sagot niya sa IOI plus rep performance. So, kung bansa ninyo dito, inquiry, observe, inspection, that is to examine or to trace or to perform, uulitin mo lang siya, mga ganun. So, whenever we test controls, iikot lang yan sa apat, IOI plus the performance. So, tulad dito, inquiry, observe, and inspect. So, why again that we need to cut off? Because it also provides evidence of existence of that particular sale. Next assertion, valuation and allocation. So for valuation and allocation, what we want is that the sales are correctly billed and recorded. So for controls, first, for goods shipped, it is counted and descriptions on sales orders are compared with the shipping document. If you still remember earlier, when we discussed your different departments involved under your shipping, the shipping department, must compare the SO with the inventory that will be shipped. So that's one of the control in place in your shipping. So how do we test that? We observe whether that procedure is performed. Again, observe. And then lastly, examine the shipping orders for signature on the shipping documents. So here, what we want to do is whether there's a proper authorization over the shipping document. Proper authorization over the shipping document. And when we say proper authorization on your shipping document, this is initiated, of course, by your shipping department. Okay? But again, still the same, iikot at iikot ang TOC mo sa IOI plus rep performance. Observe while examine talks about inspection. Next, customer credit is approved by a responsible official prior to shipment. So when we say customer credit is approved, this talks about the function of your credit department. If you still remember earlier, we said that for the credit department, once there's a sales order, they will first approve the sales order. The credit department wants to approve that because we look into whether the customer can pay or not. That is to minimize possible exposure for default. So here, we want that the credit department will approve the SO. Therefore, how do we test that? How do we determine that the SO was approved by the credit department? So to test that, what you need to do is to examine the sales order whether there was a proper credit approval. Again, the control is that, sabi doon, approve daw yung credit bago i-ship. So paano natin iti-test yun? Tignan nyo yung sales order kung in-approve na talaga siya ni credit department. Kung ginawa nila yun, then ibig sabihin, the controls are working effectively. If not, then hindi nag-work yung control. Ganun lang naman yun. Next, sales invoices are checked to pricing, mathematical accuracy, and terms. So, how do we test this control? If you still remember, we wanted the credit department we wanted the sales department to have the amount of inventory and the prices on those inventory. So that when they prepare the sales order, those inventory and the prices therein are correct. So how do we test that control? We inquire on the price list, whether it is properly updated or not. So how do we determine whether the price list is properly updated or not? If you still remember, the warehouse must monitor the inventory levels. At the same time, we should determine the list of the warehouse um, monitor the inventory levels, while the sales department will monitor the list of prices. So those items we try to match. So if you want to inquire on the price list, you can ask the sales department. If you want to inquire as to the number of inventory left, you ask the warehouse. Next, examine copies to determine that they contain signature that they have been checked. So you look whether the amounts are properly checked and the inventory are properly checked. So you just examine whether those reports, especially on inventory prices and the number of inventory on record, are proper and at the same time were prepared by the sales department and the warehouse department. Next, control. The AR subsidiary ledger is balanced to the general ledger control account regularly. So this happens in your AR department. This happens in your AR department or your accounting department. So first, test of control, you observe whether such procedure is being performed. At the same time, we foot the subsidiary ledger and compare to the balance of the control account. So when we say foot, you get again the total, right? So it is equivalent to reperformance. You just get the total or reperform the mathematical accuracy of the amounts in the ledger. Next assertion, rights and obligations. So the sales recorded represent only sales transactions. So what are the controls in place? So the clerk checks sales orders and sales invoices for the different terms. And how do you test that? Again, observe. Next, presentation and disclosure. Here, we want that the sales and AR are properly recorded in accordance with the PFRS. Not only properly recorded, but also properly disclosed in accordance with the PFRS. So what are the controls in place? That the sales must be properly classified. So we want to determine whether the invoice copy contains approval signature for account classification use. So ultimately, guys, since we're looking into an account item or account balance, so to test that, we have the different assertions for the account balance. And those assertions are first, we started with existence and occurrence. Next, after existence and occurrence, we have completeness. After completeness, we have valuation and or allocation. Then we have rights and obligations, and then presentation and disclosure. But here, we are testing the test of controls. We are testing the test of controls. And what I want you to always remember whenever you are testing the controls on a particular assertion, the test is only within inquiry, observation, inspection, plus reperformance. So pag binigyan kayo ng choices, which of the following is not a test of control for this assertion, pag wala siya dyan sa apat na yan, yun na yung sagot nyo. Ganun lang naman yun. Iikot at iikot lang yan sa inquiry, observation, inspection, and performance. Or pag tinanong kayo, which of the following is considered as a test of control for this particular assertion, then dapat yung first niya is either inquiry, observation, inspection, or performance. Doon lang iikot yung sagot. So, laging yun lang. Pag nag-gets nyo yun, di madali lang siya. And at the same time, I hope mas nag-gets nyo siya kasi we already discussed the whole process at the same time. In each particular process, we look into the different controls in place. Now, we're just testing the controls in place. Next, we look into your sales adjustments. So for your sales adjustments, we said earlier, we have your returns, we have your allowances, and we have your discounts. So the first transaction is your sales returns, allowances, and discount. And we only test two main assertion, and that is existence and completeness. So first, existence. The emphasis is on testing the existence of the recorded transactions as a means of uncovering any diversion of cash from collection that have been covered up by fictitious sales returns and allowances. So we want to test the existence whether there's a proper returns, allowances, and discount. Why? There can be fraudulent activity here. So assuming you have a sale on credit and you have already collected it. So if you don't want that the cash will enter the entity, you want to misappropriate it. If you want to misappropriate it, you record it as a return allowance and discount. So to determine whether there's a proper return allowance and discount, we check for the existence of that return allowance and discount. At the same time, we look into your completeness. For completeness, there can be understatement as to your returns, allowances, and discount. If there's an understatement, then possibly there is an overstated net income. Particularly, existence applies to your misappropriation of assets, while completeness applies to your management. So this could be a fraud of your employee, and this could be a fraud of your management. That is in the use of your sales returns, allowances, and discounts. So we have here fraudulent financial reporting for the management. And then we have also your misappropriation of assets for your employee fraud. Next, we have uncollectible accounts. This is for your AFDA or your allowance for bad debts. If that is AFDA, the expense is known as doubtful accounts expense. If that is bad debt, we have your bad debt expense. So the first one, existence. Why is it existence only? Because of the possibility that the management may use this account to cover up misappropriation of your company's assets. The control is to prevent proper employee proper authorization when writing off uncollectible accounts. Okay, if you still remember earlier, we said that the AR should only recommend write-off. So how does the AR department recommend write-off? The AR department recommend write-off by performing aging of receivables. If you still remember earlier, we said that the AR department must review the different customer accounts, and by reviewing it, we can prepare an aging of receivables. And because of that aging, we can recommend the proper write-off. But take note, it is the treasury or the treasurer who now authorize the write-off. So what do we want here? Again, a proper segregation of duties. Because if there's a proper segregation of duty, then possibly we have a proper internal control in place. If you still remember, we have your different control activities, right? And whenever we say control activities, these are the different internal controls in place. And the most common control activities are your forms. But mostly, for these items, we look into your segregation of duties. Okay, we look into your segregation of duties. Aside from, of course, aside from authorization, aside from reconciliation and verification, mostly, since this is a cycle, we look that there are proper employees within the certain cycle, which now segregate the duties for custody, authorization, and recording. Okay. Next, sales transactions. So we're done talking about the TOC of sales transactions. We're done talking about the TOC of your sale adjustments. Now, let's go to your substantive test of sales transaction. So the first assertion here is occurrence and validity, rights and obligation. So always remember, if the TOC, based on your TOC, the controls are working effectively, then you do less substantive tests. But if the controls are not working effectively, then you do more substantive tests. So we're done understanding the entity itself. So how do we understand the entity? We understand the whole cycle. And after understanding the whole cycle, if ever you want to rely on your controls, you do TOC. But if not, you can go directly to substantive tests. If you follow TOC, after that, you check whether the controls are working effectively or not. So less substantive tests or more substantive tests. But if it is purely substantive tests, of course, you do more substantive tests. Why? The controls now, uh, the controls now, you will rate it at high, meaning you have high risk, meaning the internal controls are not working effectively. So let's go now to your substantive test of your sales transactions. Again, this is dependent whether you did your TOC or you purely rely on substantive tests. So first assertion, occurrence and validity, rights and obligation. So your audit objective here is to determine that recorded sales are authorized and are for shipments actually made to real customers. We want that if there is a sale that is recorded, we want that this particular sales recorded was given to a real customer. Okay? We want that it is valid and it really occurred. And since it is valid and it really occurred, you now record your rights and obligations. In this case, you record your rights as to AR. So debit AR, you credit sales. Okay, so what are your audit procedures to test whether the sales really occurred and it is a valid sale? First, you review the sales journal, the general ledger, and accounts receivable master files or trial balance. And then, we trace now from your sales journal entries to supporting documents. So here, it is now from records to supporting documents. That's why it is now known as tracing. And then, we trace also your shipping documents. We trace your shipping documents to your entry of shipments in perpetual inventory records. Okay, so if you want now, earlier from records to sales documents, this is known as vouching, and this is shipping documents to records. This is really tracing. Okay, next, we want to compare prices on sales invoice with authorized price list or contracts. So those are your different audit procedures to determine whether you reach the proper audit objective. That is, whether what is recorded was actually real or valid. And based on those items, we want to determine whether we have now a right or corresponding right on that particular sales. So how do we do that? First, we vouch from your records to your supporting documents. So what are your supporting documents? If you have your journal entries on your sales, then you look whether it was properly shipped, whether there's an invoice on that, whether it is properly approved, whether there's a sales order. So we look into those different documents and see whether it corresponds on our records. Next, we try to trace the shipping document to your perpetual inventory records. Here, we look now into your shipping document, whether that particular shipping document, it means that when we say shipping document, it means that the inventory was now transferred to the customer, right? Or undergoing shipment. So we look whether that undergoing shipment was properly recorded on our inventory records. Here, we want to see whether there's a valid sale. Here, we want to see if ever we already have a right over that sale. So assuming you sold FOB shipping point, FOB destination, etc., you look into the effect whether there's a proper sale based on your records. And then we also look into the amounts as to our rights and obligation. And to determine our amounts, we look into the prices of sales invoice with the authorized price list. Next, completeness. For completeness, we determine whether the existing sales transactions are recorded on a timely basis. So we only want that here we have a complete amount of sales. So what are our audit procedures? Again, shipping documents to your invoices and entry to sales journal and AR master file. So earlier, we want only to check shipping documents to our inventory records. That is as to occurrence and validity and rights and obligations. For completeness, we are now tracing the shipping documents to SI and then to your entry of sales journals to AR master file. So here in your completeness, i-check mo na lahat. Shipping to SI, to sales journal, and then to AR. At the same time, we compare the date sales are recorded and date on your shipping records. Why? We want that in your completeness, as earlier stated, we want that it is properly reported on the proper month. It is complete for January or complete on February, etc. That is for our cut-off test. Another assertion, we have your valuation or allocation. This talks about the amount of goods ships are properly billed and recorded. So here, our audit procedures are recomputation on your sales invoice. We can also trace our sales journal to sales invoices, and we can also trace the details of sales invoices to your related documents. And then lastly, we have your presentation. For presentation, we look into whether it is properly classified in our financial statements. So what is our audit procedure? You just need to examine the documents supporting the sales transactions for its proper classification. So whether it is for sales, is it for returns, for allowances, for discount, or whether it is for other items if you want to break down your sales. So it could be also service if ever that is a multi-product company or different if the company is also selling services. So if you want to divide the amounts or properly present it, then it must be properly presented by looking into your different documents which supports the sales transactions. Now, how do we test the returns, allowances, and discount? For returns, allowances, and discount, our main assertion to test here is the validity of our returns, allowances, and discount. So what is our audit objective? It has the same audit objective with sales. And then we look into the materiality. If amount reflected in the credit memos are immaterial, you can ignore it. But if it's material, you try to test it or you test it. So what are your audit procedures? First, review the use and authorization of your credit memos. And the credit memos must be serially numbered, signed by an employee separate from handling of cash or maintenance of the customer's ledger. If you still remember, for a credit memo, the approval is within your sales department. Next, review of credits for returned merchandise supported by receiving report on the return shipment. If you still remember, it is the warehouse who will receive the goods. But the approval of the credit memo is on the sales department. So we look into the sales department and the sales department credit memo and the receipt by your warehouse. At the same time, you verify any prices, extensions, and footings as to that particular credit memo and return. And then you now trace the postings from sales returns journal and other accounting records to the subsidiary ledger of the customer. So assuming it is customer A who returned, then the return must be properly reflected in the subsidiary ledger of the customer A. Okay? Now, since we finished the substantive test and test of controls of your sales, we go now to your test of controls of your receipts. Take note, we are talking about two items here. First item is your revenue or your sales. The second item is your receipt or your collection. And since we're done with the TOC and substantive test of your revenue or sale, let's talk about the TOC and substantive test of your receipt or collection. So for your cash receipts, first assertion is your existence or occurrence. So here we look into the recorded receipts, which represents actual cash collections from customers. So let's look into the controls in place. First, an employee prepares a pre-listing of cash receipts. Again, who prepares for the pre-listing of your cash receipts? We said the mail room. Okay, earlier we said it is the mail room who prepares now the cash receipts. Now to test this control, you again observe the pre-listing and also you inquire about the procedures. Again, we are under TOC. So iikot lang uli yan sa IOI plus performance. Another control for existence or occurrence is that a validated receipt is obtained for deposits and compared to cash summary. If you still remember, it is the Treasury Department who now do the banking or the deposit. At the same time, they will prepare a report. So here, to test this control, we compare the validated slips or deposit slips from banking to our cash receipt summary. Next, we test for the segregation of duties for the handling of cash and the posting of AR. For the handling of cash, it is the treasury, right? While the posting to AR, it is the accounting department. So, to test that control, we need to observe the separation of duties. So, is it really the treasury who handles the cash? And is it really the accounting department who posts to the AR? At the same time, you try to inquire from personnel about their responsibilities. Because if in case, baka kasi yung treasury and reporting or for the updating of for the accounts, it is purely on your purely under one person. Therefore, there's no segregation of duties. Next, the preparation of a bank reconciliation by a person independent of cash, AR, and your general ledger. So how do we test this? Again, observe whether a bank reconciliation had been prepared by an independent employee. So again, umiikot na naman tayo sa IOI plus rep performance kasi bumalik tayo sa POC. Next assertion, completeness. Under completeness assertion, all receipts are processed and recorded. So what are the controls in place? Pre-listing and monitoring of your cash register procedures. How do we test this control? You just observe the procedure as to your cash register. Next, checks are restrictively endorsed immediately after receipts. How do we test this again? Observe whether the procedure as to the endorsement of your check are properly followed. Next, preparation of daily cash summary and reconciliation of your cash receipts and pre-listing. If you still remember, daily cash summary as to your receipts and pre-listing, all of these items are segregated in your mailroom, treasury, and accounting department. So how do we test that control? You again inquire from the responsible employees in the mailroom, treasury, and accounting department whether there is a regularity and consistency in the performance of this procedure, whether the preparation of your different summaries and the reconciliation of these summaries together with your deposits are really are performed regularly and consistently. Another control, reconciliation of cash receipts to your total posted on your AR. So here, we look into the general accounting and the AR department. So again, you need to inquire as to your responsible employees regarding regularity and consistency. Still the same, since TOC, iikot ulit sa inquiry, observation, or inspection. Next, TOC of cash receipts, we have your rights and obligations that all cash receipts are deposited in the bank account of the client. So let's look into the controls in place. The controls in place is that the cash receipts are deposited intact daily in the company's bank account. Again, who deposits? It is the Treasury Department. So how do we test this one? You observe whether the procedure is followed and compare the cash pre-listing with the validated deposit slip. The cash pre-listing comes from the mailroom and the validated deposit slip comes from the Treasury. So normal procedure, what they normally follow here is that if that is a sale in the current, if that is a sale for today, you will cut off at a particular time, and after that time, you already need to deposit it. So let's say cut off until 2 p.m., deposit it. Any collection after 2 p.m. will be deposited the next day after. So normally, it depends on the policy of the company. But normal business practices, they will cut off on a particular day. And then after that cut off, what they will deposit it Anything left after the cutoff will be deposited the next day together with the collections for the next day. So, ganun normally yung ginagawa nila. Next assertion, valuation and allocation. So, the, uh, the, the debit to cash and the credit to AR are valued at amount actually received. So, whatever is received must be equal to the amount you remove on the subsidiary ledger or the general ledger on your AR. So what are the controls in place? The cash receipts should be recorded at the amount indicated in the remittance advice. If you still remember, the remittance advice is the amount of payment made by the customer. So whatever is the payment made by the customer, that must be your debit to cash. So if the remittance advice is 1,000, then the cash should be 1,000 and a credit to AR for 1,000. Now, how do we test that control? To test that control, you just need to compare the entries made in the cash receipts journal to your remittance advices. So we want to look whether the remittance advices were properly recorded in our cash receipts. So you try to look and compare cash receipts, therefore, to your remittance advice. And last, for your cash receipts, presentation and disclosure. So here, the cash receipts or transactions are recorded in accordance with the PFRSs. So the control in place here, an accounting supervisor approves the classifications made in your journalizing. So here, we determine whether the accounting supervisor approval is recorded. So this is more about inspection or inquiry. Okay? So again, mostly for your TOC, you determine or we focus on our directional testing. So whenever we say directional testing, that is either from your source document to your records or from your records to your source document. If that is from source document, we call it your tracing. If that is records to source document, we call it your vouching. And normally, the main assertion depends whether it is asset or liability. For asset, our main assertion is existence. And for liability, our main assertion is completeness. Now, tracing is for completeness assertion. Okay? Tracing is for completeness assertion. So normally, this is applied to your liability or your contra accounts. For vouching, this applies to assertion of existence. Therefore, mostly, it applies to your asset. And for liability, why is it completeness? Because normally it's understated. For your asset, it is normally overstated. That's why we look into the existence. To check the existence, if this is the recorded asset, we check whether really we paid for that or it is a valid amount of asset. We look into whether it is properly supported by a source document. Now, if ever we want to look whether our records are complete, we trace from source documents going to our records. That's why here, tracing, the main issue or the main assertion is completeness. And for vouching, the main assertion is existence. And completeness applies to liability generally and existence to your. Okay, next. Substantive test of cash receipts. So we're not yet done. We're still on your substantive test of your cash receipts. So we already finished TOC and substantive test of sales or revenue. We finished now TOC of your cash receipts. Now we go to your substantive test of cash receipts. So substantive test of cash receipts. First assertion, existence or occurrence. So your audit objective here is to determine that recorded cash receipts represents actual collection. So whether it really exists. So what are your audit procedures? You trace cash receipts journal to pre-listing of cash receipts and to remittance advice. And we already discussed how to properly trace those amounts. Next, we reconcile daily deposits to validated deposit ticket or validated deposit slip. And we already discussed how to properly reconcile that when we discuss about your TOC. But generally, in your TOC, you are just inspecting. Here, you are already reconciling. So when we say reconciling, we look into the total of daily deposits, we look into the total of your validated deposit slips, it must be equal. Next, completeness. On your audit objective, you determine that all cash and checks are recorded. So what is your audit procedure? Your audit procedure is to reconcile daily listings and validated deposit slip to cash receipts journal to verify that all cash receipts are recorded. So in your daily listings, this is prepared by your mailroom. And then your validated deposit slip comes from your treasury. And your cash receipts journal is prepared by your general accounting. If you still remember earlier, when we talk about the different departments relating to cash receipts, yung tatlo lang naman yun. Mailroom, treasury, and at the same time, your accounting department. So you now reconcile the reports from those three entities or three departments. Next, valuation or allocation. This is to determine the debits to cash and credits to AR are values at amount received. So katulad din ng TOC kanina sa valuation or allocation, same sila ng audit objectives sa substantive test. Here, we examine the remittance advice and verify that discount taken was appropriate if in case there was a discount taken. At the same time, you need to put the AR subsidiary ledger and reconcile it with your general ledger account. Because what we want is that the totals of your subsidiary ledger must be equal to the amount presented in your general ledger. And then lastly, presentation. Again, total of SL must equal to the presented amount in the GL. Next, presentation. To determine that cash receipts transactions are presented and disclosed in accordance with PFRS. So what are your audit procedures? We review account coding in the cash receipts journal. And how do we review the account coding in the cash receipts journal? Then you look into the different transactions in your cash receipts journal and see whether they are properly presented or properly placed in the SLN to your GL. Okay, and that's it for your sales and your receipt, or also known as revenue receipt cycle. So here again, you look into the different departments, the different activities per department, and at the same time, the different source documents from these departments. And based on these departments, activities, and source documents, we look into the different controls in place. You either test this control or ultimately you go to substantive tests. That's why whenever we talk about TOC and substantive tests, we both have a TOC on your sales and a TOC on your receipts. At the same time, a substantive test on your sales and a substantive test on your receipt. So that is all what we have discussed here under your revenue receipt cycle.